This is going to be a jam-packed hour. I am so excited. You guys, I made a very costly mistake about 10 years ago. I got my real estate license, I started making money, and I needed an accountant. So what did I do? I went on to Google and I typed in accountant in my area. So write in the chat, give me a yes if you did the exact same thing. So for the last 9 years, I was using an accountant, not because they were referred to me, not because they were the greatest accountant, but because it simply was the first one I found. And I've spent the last few years finding rooms of people who were investing heavily into real estate and growing really big businesses. And I was in Phoenix a couple of months ago and Brian spoke, and I was super impressed with all of his knowledge and the different tax strategies that we as real estate professionals have. And I asked him about 10 days ago if he would do this. And I mean, it's tax season, so I can't believe we got him on here. But without further ado, I want to introduce Brian. He is with Lob Lolly Solutions out of Atlanta, Georgia, and he has a presentation for us today. And then I want you guys to save your questions, because towards the end, we're going to do a live Q&A, and he's going to answer all of the questions that you have throughout his presentation today. So Brian, I'm going to give you the floor if you want to go ahead and share your screen with us.
All right. From Lob Lolly Solutions, we started this firm in 2021 to be tax strategy people and not just focus purely on tax compliance. So you'll see people find us because they want to do tax strategy and become more tax efficient and make sure they take advantage of all the opportunities. We work with all kinds of people, big, small. People, our specialty really is entrepreneurs, particularly in the real estate space, because there's so much flexibility in the tax code. But we are a firm that, we just really want to focus on not the compliance, but the strategy. Now, do we do the compliance? Yes, because when we first started this firm, we said, hey, we're not going to do one tax return. All we're going to do is help people and do consulting and strategy. But that didn't work out very well because we saw how poorly tax returns were being prepared. So we do compliance as well. So we prepare lots of tax returns, we do lots of K1s, and help people all at the same time. So it's worked out well. Our home base is in Atlanta, Georgia, but we have clients in probably I think 43 states at this point. So we have, we stretch all over the country. So proactive, like I tell people all the time, as tax people, we can do a lot of things if we're proactive. Like, we like to hear that you're going to have a baby, not that you've had a baby. So if you're able to plan for something, we have a lot more options than we do after the fact. So we don't want to be in the compliance mode and be trying to figure out how we can be tax efficient on the front end is much better. So the other thing we say, and just to make sure we lay out there, is that we stay in our lane. We're accountants and tax strategists and all that. If you want us to be an attorney, we try to stay away from that. We know lots of good attorneys that we can help you, refer you to, especially when we start talking about trusts and estates and things of that nature. But, you're the quarterback. You're going to have a lot of people on the team. We want to be part of that team, but we don't want to do somebody else's job because we wouldn't be able to provide the maximum value for you for that. So we're going to talk about some tax advantages today. Some topics you probably have heard. I mean, we have people talking about conservation easements, captive insurance, depreciation, how we offset market losses with real estate gains. Real estate people are always talking about that. Hey, some tax strategies are singles and some of them are grand slams. We're going to make sure that, we are doing the best we can with what's available. They don't all have to be grand slams. The singles add up to runs. So we kind of take that approach. I'm probably the riskiest person there is. Like I'm okay taking the risk. So if there's a risky strategy, I'm all for it sometimes. or most of the time, but that doesn't mean all of our clients are the riskiest people. Like my business partner is the opposite of me, so that's good. We get a good mix, and we don't ever cross the line. If there's a gray area, we want to make sure that we're exploring those options so that we can make sure we're taking advantage of the flexibilities that are in the code. And again, real estate people just have the ultimate flexibility in the code. And it's been that way for a long time. 1986 came along and they changed it to hurt real estate people a little bit, but it still is far better in the real estate world. So when we talk to real estate people, and the way I'm structuring this today is so that we can talk about for 30 minutes, we'll talk about, hey, this is what we talk about most of the time with real estate people when they're brand new to us, no matter their size. And then we'll talk about some questions and answers and make sure that we get that going. If you don't have questions, then I have more to talk about. So we'll make sure we fill the time with some good stuff. So everybody comes to us and they want to be an S Corp. And real estate people, it's the scariest thing. If we have ordinary income, real estate agents have ordinary income by making commissions. Flipping homes is ordinary income where you're flipping them and not renting them and using them for investment purposes. So all those sort of things that are ordinary income, we love for it to be in an S Corp. That's great because we can hide things from self-employment or mitigate self-employment taxes. However, the thing that we see real estate people do, and I think it's at an all-time high. If we could see Jonathan, he'd be shaking his head. It's at an all-time high right now that we are fixing people's problems that put appreciating real estate in an S Corp. If you've got a rental property, please, please, please do not put it in an S Corp, because all it does is cause us a potential problem down the road when the S Corp hasn't provided you any benefit for putting an appreciating property in the S Corp. So what do most real estate people need? If you're going to be a real estate agent and make commissions, if you're going to be a real estate flipper and have ordinary income from flipping, we want all those activities in an S Corp. Then on the other side, you're going to have just an LLC that's taxed as a partnership if you've got multiple members, or maybe it doesn't even have another member. Say you're a sole owner of this LLC, it's just disregarded, which is fine as well. But you will put the appreciating real estate, the real estate that you're renting, into that LLC, because that's where you're going to get the maximum tax flexibility, not in that S Corp. The S Corp handcuffs us, and we have seen a lot of people have unintended tax consequences for an S Corp setup like that, where they're putting appreciating property in there, and it's not the easiest to fix, and it can be very, very expensive in terms of what taxes you pay. And sometimes it's without cash income. So you're just think about that. You're getting income allocated to you, no cash in your pocket, and you have a tax bill. That's not a good, that's the opposite of what we like to do. So the other thing I'll say about LLCs and S Corps, just as a generality, most people tell us they need an LLC so that they can write off business expenses. And that is not true. You get the same deductions no matter how you're organized. LLCs and the legal structure is just that: legal protection, asset protection, legal liability, things of that nature. The LLC doesn't do us anything in terms of tax savings. You still get the same tax savings, they're just reported differently. The S corporation has some tax benefits because we can mitigate self-employment earnings by having payroll and distributions and things of that nature. So the S corporation is the way to go, but not the only way to go. Make sure that you're setting it up the correct way. And that takes planning and all sorts of people to get involved, just to make sure that you're doing everything the right way on the legal front, the tax front, and operations front. If you're going to develop something one day, or you're going to start a company one day and and you're going to sell it, sometimes you want to make sure that you are doing a C corporation instead of an S corporation, because when you exit out of that C corporation one day, you could get a $10 million gain exclusion, which is incredible. It's one of the best things in the tax code right now. So as you're starting things, go through at the beginning of time of the entity, or at today is, it's late, but later than perfect, but you can still do it today. Don't think it's just a one-time and done thing. Look at it, make sure that you are considering, should I be an S Corp? Why or why not? Should I be a C Corp? Why or why not? Should I just be an LLC? Why or why not? And we always tell people to be intentional. So there's going to be a right and wrong answer. It's not going to be the same for every person. That's why there is not a slide in here that says this is the magic key. But what you want to make sure you're doing is being intentional about your decision so that you know why or why not you're doing something. Okay. When Trump passed his big tax changes way back when, at this point, time has flown. You've gotten something called qualified business income deduction. This is that 20% tax break that's provided to pass-through entities. Well, unfortunately, this thing has some thresholds and some limiters on it that people ignore, don't know about, and at tax time, they get surprised because they didn't get their 20% deduction because they didn't do the right things during the year in planning. So what happens is the QBI was set up so that the small business owner that has a partnership could have the same corporate tax rate that the corporations have, which the big time corporations only pay 15% tax, 21% tax. So if you're in the highest tax bracket and you have an LLC tax as a partnership, you're paying double what the corporations are paying. Well, that doesn't make sense. So they tried to even the playing field with this QBI deduction, qualified business income. So this is kind of a decision tree for that. We're not going to go into the details here, but one of the things that gets people, if you've got an S corporation and it makes, let's say it makes $100,000 of net income, you're entitled to a $20,000 deduction just for doing business as a small business owner. So instead of $100,000 of income, you've got an $80,000 because you got this 20% QBI deduction. But it's going to be based on salaries. So let's say you didn't pay yourself anything. Well, you get 50% of the salaries. So 50% of zero is zero. So the maximum you can take for this 20% deduction is zero. So you just gave the government $20,000 deduction back that they were trying to give you. But just because of poor planning, you missed it. Real estate people, entrepreneurs, we spend more time on qualified business income planning and pass-through entity taxation, which we'll talk about later, than anything else, because it's the easy one that people will miss. I hate flipping to your form. Jonathan will text me if this is wrong, but 8995 on your tax return and seeing that you got limited and you didn't even know it. Because just in that example, $100,000, I should have seen a $20,000 deduction, and I'll flip it back to that page and you got 10,000, 5,000, 12,000, whatever it is. If it's not 20, why did we get limited? Was it worth it? And it usually is not. So we just want to be really careful on it. It happens all the time to real estate agents who have ordinary commissions coming through there. Okay, bonus depreciation. So if you're a real estate investor, depreciation has been a fun thing to have since 2017. So when Trump came in there, did all of his tax changes, he goes, hey, let's do big depreciation to incentivize people to invest in real estate. Trump's a real estate guy, so this was perfect for him, right? So it became even more beneficial to be a real estate person in this world, tax world. So if you bought anything between 2017 and 2022, and it wasn't the building, so when you go buy a house or a piece of real estate, you're buying land, building, and all the shorter life things. So like the driveway, that's 15-year property. That's not building, 27.5-year property. You're buying a retaining wall. That's 15-year property, not 27.5-year property. You're buying doorknobs. That's 5-year property, not 27.5-year property. But you don't know what you bought because you just bought a piece of real estate. So, but if you go and segregate it, we'll talk about cost segs, but anything that's not the longer life, anything that's not land, because it doesn't depreciate, and the 27.5-year building, everything else was depreciated on day one 100% through bonus depreciation. So let's go back to an example. $100,000 house. The industry average is going to say that $25,000 of that belongs to shorter lived assets. So let's say the land cost $10,000, or the land was valued at $10,000. The shorter lived properties were $25,000, leaving the rest in building. Well, that $25,000 could have been a deduction on day one that you put it into service as a rental property, investment property. So that's a big deal. Now, what's happening now? That was through all the way through 2022. If you buy something today, it's instead of 100% write off in day one, it's 80%, and the rest is depreciated over the useful life. Then in 2024, it's 60%, and as you can see in this schedule here, it keeps on going down and it eventually phases out. You know, when Trump suggested all of these changes, you know, they essentially said, hey, that's great. How are we going to pay for it? What are going to be the add backs, and where you lost like some deductions and types of deductions in other places. But the reason that we have, one of the things he did was he said, hey, we'll claw this back starting in 2023 and it'll fully expire in 2026, a lot of the individual mandates. So that's where we are. So bonus depreciation is big. It used to be bonus depreciation only qualified for new property. So you'll hear that. The myth out there is, hey, it's got to be new property. It's got to be a brand new car. It's got to be a brand new house. It's got whatever that may be. That is not true. It has to be new to you, meaning did you buy it during that time frame? That's it. So then you may have heard people say over the last few years, and we've had a lot of clients do this, where Section 179 is not even a discussion topic sometimes. Section 179 was how we could accelerate depreciation before bonus depreciation was so lucrative. The one thing I'll say is there should be some tax planning. It's less efficient for real estate people sometimes, but there still should be the planning of, should we be doing bonus depreciation, this big write-off we just talked about, or should we do Section 179? The difference being, if you're in a tax state, a state that has income tax, you may be better off with Section 179. But there's all sorts of other limits that have to be considered. So it just should be factored into your planning checklist. Then some things in the tax code you would never think are 15-year property, but they are. Car washes, gas stations, and oil and lube service stations are all considered 15-year property. And what did we say about 15-year property? It was 100% write-off in day one. So we had a lot of people go out and buy car washes for the humongous depreciation benefit. And we just talked to a client the other day who went out and bought a gas station where he's going to end up retiring. So he's got a gas station out there. I think he bought it for $3 million. And so he's got a lot of depreciation that he's able to use to offset ordinary income, which is nice. Okay, so cost segregations. So cost segregations are all about accelerating the depreciation. And as a real estate professional, I'm not one. So if I accelerate my depreciation, I can't use it if it's in excess of my rental income, my net income from the activity. So if I've got a rental property, let's say that it makes $10,000 in rent, and I've got $12,000 of expenses, so I'm negative $2,000 of cash loss. I can't use any depreciation. Doesn't matter. I can't even use a $2,000 loss. I can only break even. Every other loss I get has to be carried forward. But if I'm a real estate professional and I materially participate, then I get the depreciation and any loss I don't have to carry it forward. And that's the biggest difference between you and me. And that's the biggest difference in the tax code of why it's so flexible and advantageous for real estate people. You can take all this depreciation up front. So let's say that you bought this rental property and it's got $25,000 of that short-lived property. I may not be able to use the $25,000 of depreciation, but you can. And that's an amazing thing because it offsets any other income. It does not discriminate. So if you've got $150,000 on a W-2 and $150,000 of depreciation, you just offset it. It's gone. You have no tax. And we have a lot of real estate people that have a lot of depreciation like this. They do not pay any tax because they've offset all of their income with depreciation. So You accelerate the depreciation, you get the expense, and you pay less tax, and therefore you have increased cash flow to go leverage and do it all over again. And that's how all these real estate people have so many holdings, because instead of paying the government taxes, they have paid for more real estate assets that are producing all of these great things for them. At the end of the day, what happens? Me and you even up. Because at the end of the day, you've got an asset that has very low basis because you took a lot of depreciation and I didn't. So at the end of the day, the tax benefit is usually close to the same. But what's the good news? You took it all up front, and we'd always rather save $1 today than tomorrow. So it's a big, big thing. So if you hear real estate people talking about cost segregations, that's what it is. If you're a real estate investor and you're starting to go through sales and you don't want to pay tax, a lot of people will do a 1031 exchange where you're going to take that property, you'll sell it, and when you sell it, all the proceeds will go to a qualified intermediary, and that qualified intermediary will block you from tax, essentially. And then you're going to take 45 days, identify a new property, and then within 180 days, you're going to buy that new property. So in 6 months, you bought this new property. And as long as that property was more than the property you sold, as in fair value, so you sold it, if you sold a property for $100,000, the next property you replace it with needs to at least be $100,000. You've just deferred your gain. You have no gain to recognize. And you've got a new asset that's producing and things of that. So that's another good way people avoid or defer tax when they're doing a 1031 exchange. Your basis in your new property is reduced by the gain you are deferring. So if you have a $100,000 gain, you go into a new property that cost $1 million, your $1 million property really only has a basis of $900,000 because you reduce that basis with your deferred gain. So instead of a $1 million depreciation, depreciable asset, you've got a $900,000. So a little bit different. Some 1031 exchanges are the very basic. Like I could walk you through them. But if you have a CPA that tells you they know everything about 1031, that's the wrong CPA, I promise you. Because 1031s have so many wrinkles that are good wrinkles because it gives you flexibility. So you can do one in reverse. Like I just explained to you, that the common one is, hey, we sell a property, we go buy a property, we keep on going, et cetera, et cetera. But what if you bought a property and then you all of a sudden sold a property? You can do a reverse exchange and do it in the reverse order, just like that. If you're in partnerships and you're doing this, you can do things called drop-in swaps where, if one partner doesn't want to do it, but the other three do, they can. So there's all sorts of deviations from the original that we just talked about. So just make sure when you're considering 1031s, there is ample planning time to make sure you're leveraging the timing so that you're leveraging tax efficiencies. What's the alternative to 1031 exchanges? Let's say you have this gain and you don't find a property you want to replace it with, a replacement property. You can use DSTs, Delaware Statutory Trust, where you can put your gain in there. Real estate people don't usually love these because it's a big trust and you just given up your opportunity to manage it. So a lot of real estate people like to manage their own property, like to control it, what their money's doing and things like that. So, but they're out there. So if sometimes I think DSTs get their bang for the buck, because if you're coming up against your deadline of 45 or 180 days, you can put it in there and and it's probably sitting there ready to go. And there's less opportunity for you to bust your 1031 exchange. You can do qualified opportunity zones, where meaning, if you want to get into one of these designated areas that the IRS designated that are economically distressed areas, and you have good assets, that we're going to meet all the qualifications. And this is a humongous talk we could have later, but you could go, but there's QOZ funds out there where you can go put money. You could put your 1031 proceeds in there and be able to, no 1031 proceeds. Instead, you're going to put your gain into a QOZ, and you get to defer your gain. The great thing about a QOZ is this. Let's say we have that $100,000 gain. We go put it into the QOZ. In 2027, we're going to pay our deferred tax. So it's 2023 now. So I'm giving you a 4-year tax deferral. So instead of paying $20,000 in tax now, you're going to pay $20,000 in 2027. So that's 4 years. That's pretty good. But this is the kicker. Let's say that you held that property for 10 years. You got to hold it for 10. In 10 years, you're going to sell that property for a $500,000 gain. It's permanently excluded from tax. You never pay tax on the appreciation of a QOZ, which is incredible. We've got a lot of people in year, I guess it'd be year 6 now. Is that right? Yeah, year 6. So they're 4 years away from having tax-free gains. So look, that's a good example of tax planning, right? We're 10 years ago, we started tax planning for people that they're going to come and take me out to dinner and give me a hug and fly me around the world because they're not going to pay tax. But it took 10 years for them to realize this strategy, but it's going to come. It's here. It's almost here. A lot of people will use insurance and trust strategies to mitigate gains and to make sure everything's in the right place for estate reasons and just gain mitigation. You can cash out, just say, look, I'm going to pay for my gain now, but I'm going to go get something that's depreciation rich, like a gas station potentially, and things like that. So those are really the key alternatives we see to 1031 exchanges. And the great thing about 1031 exchange as well is that when we have depreciation and recapture, we can kind of reset it when we go to 1031s. And so when people hear about depreciation recapture and they come tell us like, I'm going to pay so much in depreciation recapture, 1031s kind of mitigate that if you make the appropriate elections. Okay, this was just a picture of the difference between 1031 and the call for opportunity zone. 1031s, like the investor doesn't leave with any money because we put all the money into the new property. In an opportunity fund, you can see the investor gets some money, they get their basis back. Only the gain has to go into the opportunity fund to defer the gain. So less money has to be levered in order to get the same tax benefit, with the QOF having the additional benefit of the sale for tax-free. Okay, tax credits. There are people that specialize in tax credits. CPAs do not specialize in tax credits. We specialize in how to report them. I do know that some of them exist, and I can tell you about them, and then I've gotten really good at some of these credits. But real estate people, if you have real estate investments, 45L credit has been very popular and should be looked at. It's basically saying that, hey, if my property is energy efficient, and this is what the 45L people tell me, Brian, you can't buy an HVAC system anymore that's not energy efficient. You can't buy windows anymore that aren't energy efficient. So people are energy efficient, they don't even know it. But this 45L can be worth up to $5,000 per door. So if you got 5 properties, it could be worth $25,000 of tax credit to you, not a deduction, but a credit, just literally money in your pocket. So be aware of that. There's lots of solar credits out there right now, lots of various credits. One credit that we can talk about is if you're a real estate people and you had W-2 employees, if you own a business and you have W-2 employees, then you probably have a good chance to qualify for the employee retention credit. If you turn the radio on or looked at billboards or have ads on your Facebook feed or social media feed or whatever, you've probably seen people telling you that you qualify for ERC, to call them, yada, yada, yada. Do not call them, because they want probably 25, 30, 35% of what they save you. And it's not that kind of credit. I agree that some credits are priced like that, and that's fine, but that's highway robbery for what it is. And from what I can tell so far, I'm not saying all of them, but a lot of them just tell you that you're eligible. They collect the money, they collect your money, and they're gone. They don't need to be around. And so if this thing ever gets audited one day, it's going to be tough. So essentially, if you were impacted by COVID, you should have the discussion with your CPA if you qualify for ERC. If your CPA is not the person that knows if you qualify or not, there are ERC specialists. We happen to do a lot of ERC, so I can do pretty well. I happen to also know, I think, the best ERC person in the country, and so we can definitely put all the complicated versions with him. And he's down in the Panhandle of Florida. So and has done a phenomenal job. But if your revenues decreased by a certain percentage, 50% in 2020 or 20% in 2021, with 2019 being the base comparison year, then you qualify. But we've had people in 2020 and 2021, especially in the real estate world, that had their best year they ever had. COVID was the best thing that ever happened to them business-wise in terms of revenue. So a lot of CPAs are saying, look, you don't meet it. Your revenue didn't go down. That's only one. If you were impacted by COVID, meaning where's your business operations changed, impacted, whatever, because of rules put in place to mitigate COVID, then you qualify. And if we could see everybody's hands, there's no one raising their hand unless they're sitting in South Dakota. There's no one raising their hand right now. They wouldn't be raising their hand right now that said they weren't impacted by COVID. Everybody was impacted. So at least make the decision and know that you're being intentional about it. Why? What's so important? It's worth $26,000 per employee. 10 people, 10 employees, $260,000. Now, the people that don't qualify, if you're the 50% or more owner of an S corp or any entity, your wages will not qualify. Sorry, 50.001%. More than 50% is what I'm saying. So, husband and wife own 50% each of an S corp. That will qualify because no one has majority. Any majority owner's wages do not qualify. So that's it. But it's $26,000 per employee. So do not ignore this, and don't listen to your CPA tell you that your income went down, did not go down, so you don't qualify. If you started your business, Loblolly Solutions qualified this way because we started in 2021. If you started during COVID, you started your business during COVID, you automatically qualify for Q3 and Q4 of 2021. So every employee you have automatically qualifies for $14,000. So it's pretty impressive because there's not a lot of things. So everybody goes, okay, look, what do I got to do for ERC? This is your homework. You got to confirm eligibility, which means both ways, not just because my revenue went up or down. You got to assimilate some payroll information. Then you'll do the amendments and all those good things, and you'll receive a check from the IRS in the mail for a tax credit, and then you'll go and amend your personal and business returns related to that. So that's kind of the process, but don't let that one go away. I got a lot of slides here on pass-through taxation. I'm going to say one thing about it, and then we'll move on. But if you didn't talk about pass-through entity taxation, then you did not do your job in tax planning last year, and you should start doing it for sure in 23. If you're like Candace and you're in Florida, it doesn't matter. This is for state. These are for people that have to pay state tax. Okay, Florida, Texas, Tennessee, all these states that don't have state tax, doesn't matter. You're not going to get any benefit. But if you're in another state, pass-through entity taxation is important because you can now pay your state tax through your business and get a federal deduction for it, which can save a lot of money. So this is just a picture to show you it's old now, but these are how all the states disagree with how you can and can't take it. The orange states say basically, look, we're like Texas and Tennessee, that it doesn't matter. But we have blue states, we have red states. They're not political lines, but they are, how do we want you to take the deduction? They're giving you the deduction, the ability to take it. It's just, and all these states that are, I guess, a grayish white, That doesn't mean you don't have PTET through there. You just have to do it a different way. So just be careful. A lot of people will manage their tax liability with charitable donations. We want to make sure we're being strategic about charity. We have a lot of people that give to charity and they don't get the deduction because they didn't meet the higher standard deduction. So we want to make sure that's a planning point. Like, hey, instead of donating December 31st of each year, let's do January 1st and December 31st of a year, take a year off, and January 1st and December, we're basically doubling up our deduction, and the charities are still getting their money about the same time and things of that nature. Donor advised funds, where we can preload charitable contributions. So if we have an income event one year where we have lots of income, we will see a lot of people use a donor advised fund so that we can put money away, take the deduction on the front end, and then over time we can give money to the charities from this donor advised fund. But we took the deduction all up front, which is nice. You'll hear people talk about land donations, conservation easements. These are big, big changes right now. Syndicated easements, meaning you get into a deal that had lots and lots of people in it. Those are probably going away altogether. But your privatized ones, and then just people donating land. Quick example. Let's say I have a $1 million piece of land and I want to donate it to the National Conservation so that no one can build on it. It has to be conserved forever, green space, whatever. And this is simplifying it. That's not totally true, but let's just say that's what we're doing. I get to use the best use value of that land as my charitable donation. So I've got a $1 million piece of land. Let's say that I can go, if someone chose to develop this land, it would be worth $10 million in its best use form. That's a $10 million charitable deduction. I paid $1 million for it. I got a $10 million deduction because I'm going to forgo the development and the potential gains and just donate it from day one. So that's a $10 million deduction. As you can imagine, the IRS says, hey, this is kind of weird. Like, how are we appraising for something that doesn't exist yet? Well, this is part of the law. Ted Turner, he decided he didn't want to see, when he's out there looking at his buffalo and bison and all that in Montana, he decided he didn't want to see people around him. So he started conserving all this land around him. So he's able to do it. He does it by himself. He doesn't have to syndicate it. But the rest of us that aren't that rich, I get into that $1 million piece of land. We may have gotten 45 people in there to buy that and take this deduction. So that's why the IRS is kind of all over these things. The difference between that and a charitable transaction is, let's say I had that $1 million piece of land, it could still be worth $10 million. Let's say I gave it to a local church. I'm giving a fee simple charitable contribution to this church. That's fine too. Same concept. The easement is limited to 50% of your AGI. So if I have a $10 million charitable deduction, I can only use up to 50% of my AGI each year. The charitable transaction is 30%. So some planning opportunities there. If you have an estate tax problem, when you have an estate tax problem, you don't want one. So plan for estate taxes early. If you have something where you're accumulating wealth, it's better to plan for it now instead of after you're wealthy. So go ahead and have your estate tax plan because if you have a taxable estate, 50 cents on every dollar is gone. That's what I tell people, 50 cents on every dollar. We don't want that. That's the opposite of tax efficiency. Okay, some common things that the real estate people do. If you have a primary house and you don't rent it out because it's your primary house, you can host 14 business meetings. You can rent out your primary residence for 14 days, and it's a deduction for your company, but you do not have to pick it up as income. It's called the Augusta rule. Because of the people at the Masters do this, they leave their house for 2 weeks while the tournament's going on, and any income they make, which is a lot, they don't have to pay. There's no income on it. There's no taxable income, so they get to hide it. So same thing for you guys. I can have 14 business meetings at my house, and if I do that, then I get to have a tax deduction for my business who's having those meetings, but I don't have to report the income personally. which is a nice thing to do. And you can do it for any house you own that is not rented. Once something is rented for more than 14 days, there is no Augusta rule. So it has to be a home that is not rented. The industry average, I'll say this, the national average I found in a magazine article, the Augusta rule is usually a $13,712 deduction. So $13,712 of income that you're basically taking, you're taking it as a deduction and not picking it up as income. So it's a nice way to do that. Paying your kids, you can pay your kids up to $12,500. That number's higher now, but let's say $12,500 for argument's sake, and they don't have to pay income tax. They don't have to report that, but you get a deduction for it. So again, like we got people with 3 kids and 2 houses they do Augusta rule on, you know, they just saved 12, 12, 12, 15,000, 15,000. So, you know, that's pretty good, right? So we're talking about $75,000 for a simple strategy that is not even risky, in my opinion. We talked about what's changing in terms of the bonus depreciation. Your child tax credit's back now, so if you have children, you're getting $2,000 per kid, hopefully. Very green friendly. The Inflation Reduction Act that got passed is very green friendly. So solar, electric vehicles, the 45L we talked about, all of that stuff's coming back. And that's why tax credits can be probably more beneficial now than ever. And this is the greatest thing about tax credits. They're transferable now. Let's say Candace has all these 45L credits that she can't use. I can come buy them from her. So there's going to be an entire marketplace out there now for buying tax credits. And it's going to be big because a lot of people do get these tax credits and they can't use them. So if Candace gets it and she wants to sell it to me, you know, she has $1 worth of credit she can't use. So she might as well sell it to me for 80 cents. Now she made 80 cents. Now I've paid 80 cents for $1 credit that I can use. So it's very interesting how this transferability of credits is going to work. We did have IRS enforcement. Everybody tells me this. Hey, we got a lot more agents now. Everything's more risky. That is not true. They were not able to hire as many people as they wanted. The people they did hire are very inefficient and inexperienced right now. So it's going to take a lot of time if they can keep these people. Trust me, they have the same hiring problems that any of you would. And I'm sure a lot of you in the marketplace looking for people is having the same conversations. But they can't even answer the phone real well right now. So enforcement is probably not in the immediate future. And that is what I want to talk about. I know it was a little speedy because I just wanted to see, you know, that was more of awareness so that you guys could see all the things that are out there. But I wanted to make sure we left time for Q&A. And again, this is my information that you can always reach out to me. But if we have any questions, I'll definitely answer them. And it looks like we have some that have already been answered. But
yeah, we've got a couple of questions and just a quick housekeeping item. I know many of you guys have asked, is this recorded? Absolutely. It will be sent to you later today. So you will have a recording of this. And William Bethia raised his hand. So William, if you have a question, go ahead and click Q&A, type in your question there. And we do have our first question from Tiana. She said, my accountant said it's not worth doing a cost seg on an investment property until the property is worth $750,000. Brian, do you agree with that? Or is that something he would be saying based on their specific tax scenario?
I would disagree with that because I don't know if there is a limit. Now, it depends. So I had just done a cost seg class the other day for people. And I said, I don't know what's worth it to people. That's all your personal decision. But I'm saying, if you're going to go out, like I said, let's use $100,000. Let's use a $75,000 property. I'm going to tell you that the industry average is going to give you $15,000 of depreciation on day one. Okay. if that cost seg cost you $2,500, which I didn't, cost segs cost all, it shouldn't cost that much for that thing. You're still making, because $15,000 is a deduction, right? Let's say that you're in a 25% bracket. That's saving you $3,700. Okay. $3,700, you probably paid, I'm saying you paid $500 for that cost seg, if that. So if that's worth it to you, then you would do it. But you're right. The bigger the property, the thing I will agree with is the bigger the property, the bigger the spread in that, because the cost seg costs something. But I'll tell you this, any property under $1 million, I don't know the cost seg person that still goes to that property, because they just do it using big data. They know what's in there. They know all the surrounding things now. They don't go count the doorknobs, nails, and windows and all that anymore. They just kind of do it by big data and do an analysis, and it qualifies, and it's a much cheaper way to do cost seg. So I would do, so what I tell people to do, now if this was my client or somebody I was talking to, not even if they're a client, but just someone we're doing tax planning with, consulting with, say, hey, let's do a present, hey, this is what it would really, this is the benefit you would have. And then you go, I can give you a cost seg referral that they don't even charge you. They'll give you the estimate, and then they won't even charge you until you say, make sure your accountant says it's okay for you to do it, that you'll benefit, and then we'll go and finish it. And then I've even seen where they did it all and they didn't get a benefit, and we called them back and they said, yeah, don't worry about it. We won't even charge you. Sorry, it just happens. So I think it's almost a no risk way of seeing, does it work for you? So I would do that.
Cool, thank you. All right, next question from Leah. She said that her accountant in Wisconsin said that an S Corp or an LLC would not help her as an agent unless she was making over $100,000 a year. Is that true?
I would say, so there's a cost of being an S Corp. You have to do payroll tax returns. So you're going to have to do payroll service. You're going to have to do an S Corp tax return and all that. So to me, I always kind of say the same thing. Now I'm down to 75,000 because of things I've been seeing and all that. But Jonathan and I, we both think that too. We think, people that are not making a ton of money because they're offsetting the other ways, the S Corp is much less beneficial. I think at $75,000, you break even. That's my gut feeling on that.
Okay.
Because
I've got a couple questions for you.
Now, if qualified business income ever goes away, I would change that tune completely. But right now we have QBI, which is very nice.
Great.
Well, actually, and what Jonathan would tell me to tell you now is that if I'm an S Corp, so if I'm an LLC and I'm a real estate agent, I don't even get qualified business income potentially because I have no salaries. So I would want to be an S Corp just for that. So it's a double-edged sword.
Cool. Going back to the paying your kids around $12,500 a year, is that children under the age of 18?
So it's anybody. Everybody gets the same one. Jonathan, what's the new? Jonathan's listening. What's the new number? I don't know it. He may know it, but let's just say I bet it's 13,000 now. Inflation's crazy this year for all these tax numbers. But in 2023, if you paid your if you paid your 18-year or younger kid 13,000, and he hasn't texted me the number, but we'll say 13,000 for now. They don't have to pick up income, and you get the deduction. And so that's a really nice thing. And people go, well, what is my kid doing? Like, my kid is he wears a shirt that has loblolly on it, and he's going to get 28 questions at the baseball park tonight. So don't sell yourself short of what your kid's marketing ability is, and things like that. It's, again, I don't even think it's a really risky thing to do, especially real estate people who, I tell people all the time, like, real estate agents, when are you not working, right? When are you not working? It's always brand awareness. So.
Okay. And can people pay their children that are over the age of 18, or is it only under the age of 18?
18, under 18 and under.
Okay, awesome. All right, we have just a couple of more minutes, so if you have a question for Brian, make sure you put it in our Q&A area. We will answer it. I've got another question for you. So when you talked about the QOZs in the opportunity zones, when we were in Phoenix, I pulled up the map and I realized I had 2 properties in opportunity zones. One was purchased in May of 2020, another purchased in 2021. And I urge everybody to go online and look at that map because I was shocked that I already own 2 properties in these zones. Can you just go over that again and explain what that would mean for me? I bought the property in May of 2020. So what is going to happen?
Yeah, so if you find out after the fact that you own one in there, then it's an analysis to see, hey, can we go back and how did we buy it? Can we still get the benefits and things like that? You want to make sure I agree, look at the map, the qualified opportunity zone map when you're looking at places for new investments. And you may go, well, I wanted to be there anyways, and it's a great thing. Doing it on the front end is obviously easier because there's certain ways to set it up. But like in Candace's case, we would want to make sure we go back, see if there is any opportunity, and if there is, to change it. Is it worth it? Is the juice worth the squeeze of going backwards? Or we've had clients actually find out, it's like, hey, I'm in an opportunity zone. There's a whole market of people in private equity funds that want that property. Like, it's crazy. And so then they go, I'll sell that right now and take this huge gain that I didn't even know I had because I'm marketing it as opportunity zone property. And it's a whole slew of new institutional dollars that are available to buy that. So.
Okay. And just so I understand this correctly, so I've got 2 properties. One has about $50,000 in gains in it, and the other one has about $500,000. So would they both make sense to put? What was that?
So you bought this property with so if you had a capital gain to recognize before that property was purchased, then we would want to see if we had an opportunity to say that, because the thing about a qualified opportunity zone is you have to fund it with a capital gain.
Okay.
So
that could be proven. So we'd have to go back.
Yeah,
we'd have
exactly.
to go back and look. Okay.
And it's probably not impossible. So we'd want to make sure we look at that and make sure.
Okay. And I'm sure a lot of people are asking this or wondering this, but they don't necessarily want to ask. Because you gave a lot of really good information today that I'm sure a lot of us haven't heard before. If we had to write the IRS big checks in the last couple of years, is there a way to go back and to relook at their taxes and amend them?
Yes. Amendment's always an option. Right now, you can go back 3 years from the date you filed it. So that's your thing. Depreciation, you can catch up in the year of. So you can, all the missed depreciation, you can catch up now. Or if you placed a property into service and haven't filed 2 years of returns for it, then you can amend for that. As soon as you file 2 years of returns, then you can't go back and amend for depreciation for that property. So let's say you bought a property in 21 and you depreciated it not well in 21 and you haven't filed your 22 return yet. You can go back and amend 21. If you bought that same property in 2020, you took low depreciation in 2020, low depreciation in 21, and you found out in 22 that for your 22 return, you should go cost seg it, you can't go back and amend. You've got to catch it up on the 22 return. So there's just different ways to get it. But when you do look at things, you know that you have 3 years from the date you filed something to go back.
Okay, cool. And one more question. I also know a lot of people are wondering this, write-off. Okay, basic business write-off. What is the easiest way to determine if something is a write-off or not a write-off?
So if it's got a business purpose, it's a write-off. And so to me, like real estate people, your phones, 100% write-off. Your internet connection, 100% write-off. You know, your car, are you using it for business? Let's write it off. Meals, when you're going out and talking with your spouse or your friend or whatever, those meals are deductible if you have a business purpose. The only thing you got to make sure is it has some sort of business purpose. And real estate people, I say it all the time, you're never not working, it seems like. So a lot of things you're doing can be construed to be business. And the only thing that's no longer deductible is entertainment. So And entertainment is defined as anything for enjoyment or recreation. So going out and playing golf is no longer deductible. But if you go out and have a hot dog at the golf course, the hot dog's deductible. So just make sure, I tell people all the time, when you're looking at your business expenses, it's nice to have them on their own credit card. It's nice to have them on their own bank statement or whatever, so you don't have to go back and forth between personal and business. But give me more. Let me tell you that I don't believe you in some of these business expenses, right? Because especially real estate people, because you're always working. Like you're an S corp and you and your husband want to go take a retreat down to the beach for a business meeting. Real estate people, go look at about 6 or 7 houses while you're down there, right? Simple, right? Now that trip is now a write-off. Now, you may have gone out for a personal meal or maybe you stayed 2 nights that are personal and the other 5 nights were business. So again, that's a big deduction that people take that they don't think about. It's like, man, I was really working on this vacation. I should get some sort of write-off because it's not always a vacation. You can work from anywhere. COVID taught us that.
Very good. All right. Well, we are just past our time. Brian, I can't thank you enough. This information is invaluable, and I hope you guys reach out to Brian. Again, here's his information. Brian, you're very, very accessible.
Yes.
That really surprised me when we started working together, because a lot of times CPAs seem to have a lot of gatekeepers, and I've been really impressed with how accessible you are and just answering questions about all of the different strategies. So really appreciate your time. I know a lot of us got a ton out of this hour, so I appreciate you. And if you guys have any questions, here's Brian's information, his Calendly link. Book 15 minutes with him and see if he could be a good fit. So Brian, thank you so much for hopping on here today.
All right.
If you enjoyed this video, make sure that you like it and hit that subscribe button.